Welcome to Dennis Money's 2 Cents, your weekly update of headlines and stories. I am Matt.
I'm Jake.
And I'm Rabih.
We didn't even practice.
We didn't even rehearse that. I know. We just
didn't
did
rehearse.
it right.
We had it. Welcome everybody. Rabih, we're trying to get you a little peppier today. You're a little tired. You're a little tired today.
Yeah, it happens once in a while, but we're good.
Happens once in a while when you got a bunch of school going on. You're busy at work with year-end stuff. We get it.
It's Halloween though. You got to get
It's
some
Halloween
excitement out for
time.
tonight. You know, it's always a fun day.
This is
yeah,
true.
like part
Halloween
of me
edition.
looking tired is my Halloween costume.
These are Halloween
Think of it that way.
There you
Yeah.
go. There you
Yeah.
go. Yeah, it is Halloween edition. None of us are wearing costumes. So what are we doing here? I don't know. We should have done that. We should have thought of that. Okay. Quick agenda. Market update from Rabih. We will do a real estate update, some interesting news coming out of the real estate space, specifically with brokers and agents that I think is interesting, something to talk about, like literally breaking news, people. This is breaking news. It just happened like in the last couple hours. We will hit that, and then we'll talk about why everyone is so wealthy, the wealthiest we've ever been in America, and we're still unhappy. So let's jump first to Rabih. Hit us with that market update.
Yes, are you guys ready? I've got some good stuff this week too.
Yeah, so you teased it. You teased this last time.
I know, I teased it because this week is earnings season. We still haven't gotten everyone to report yet, so we don't have as much insight as we want. But for
they didn't get your text messages telling them to hurry up for 2 cents?
I know. See?
All right. All right.
But we have like two pieces of information that tell us and try to explain how the market has been moving lately. So usually when companies report, they are reporting based on a benchmark base put out by analysts, and they either beat or not beat that benchmark. And historically, there has been a consistent surprise factor of beating what the analysts expect by like 6 to 5%. On top of what the analysts expect, both on the top line and bottom line. And what I mean by that, on like revenues and on earnings. Earnings can always, do some fancy accounting and make your earnings look good. But revenue, the top line, is much more important. And by how much you beat analysts' expectations is very important to tell you whether revenue is slowing down or it's still in a healthy trajectory. And so far, the revenue surprise factor has only been 1% over analyst estimates, which does not tell you that revenues are going down, but revenues are not breaking expectations. And, the economic environment that we've been for a while is now showing up and being reflected in revenues. But given that, and with the equity market sell-off, the forward PE ratio, which is the ratio we use to see whether the equity market is overvalued or undervalued, actually dropped from the 18 levels down to like 17.3. And, on the very long-term average, talking 20 years, the forward PE ratio is around 16. During harsh recessions, it drops down to 14. And when it's above and over, it's usually when we're in a very strong bull market. So now we're, the equity market is coming in terms and more in sync with how the economy is moving.
So
right?
Really quick, Rabih, really quick, just because we just talked about this on the client only huddle. Rabih, you weren't there. We did our best. I did my best impersonation of you. Not very well for the client only huddle, but I do think this is an important point to just slow down for 1 second. And just when we talk about, because one thing we were talking about is things that you hear in the news a lot, right? That I think people take for granted, or maybe we do, or people hear and they don't really know what it means. So what you're referring to right now is when people talk about in the market, when like media talking heads, Jim Cramer, whoever, when they talk about like stocks are expensive or stocks are cheap, you're saying they're talking about this specific indicator, which is price to earnings ratio, right? 9 out of 10 times, that's what they're talking about, right? Just the price of the stock divided by the earnings that stock or group of stocks actually gets.
Yes,
right?
Because most companies do not trade at the actual value of their balance sheets. They trade at a value much bigger than that, and that value reflects market participants' expectations for the future growth of that company. And it's kind of surreal that all of our equities, all of our companies in our minds are worth 16 or 17 or 18 times more than their actual balance sheets or like the earnings that they bring onto the balance sheet.
Or if you think of like growth stocks, like, you're thinking of like Nvidia or even small cap growth stocks or whatever, they're trading it
even much lower, 50, 60 times the earnings. So yes.
Right. Isn't that, wild? 50 times their actual earnings. So again, that's when people talk about like a value versus growth stock. A lot of times we're talking about them being cheap or expensive relative to their earnings. So again, this price to earnings ratio. Anyway, I thought that was maybe worth just taking an extra minute just to break that down. Okay, sorry, I interrupted you. Proceed.
So that's all for equities, right? And we'll see next week how it goes and what guidance we get from companies. Also, actually, a lot has been happening, but not really. They didn't move the market much, but a lot has been happening. So last week, we got the core PCE data, which is the Federal Reserve's preferred inflation measure. That's the one that they want to bring down to 2%, right? And for the past 2 months, it's been stuck at 3.7%. So inflation is not moving. Good news, because it's not increasing. You don't want it to increase, but there's still more work to be done to bring core PCE down to the 2% level. And the fact that inflation didn't really move, when you start looking at GDP in real terms, suddenly you see positive results. And I think a couple of months ago, we were looking at GDP for Q2, and I mentioned that the Federal Reserve has this website called GDP Now that tells you what the expectations of the GDP is going to be for Q3 in annualized terms. And we were like really surprised because the GDP should grow on annualized terms only like 2% a quarter. And we were looking at like a 5% number, and we're like, what's going on in Q3? Why do we expect the real economy to grow that much in the third quarter? And actually, now it's not an estimate, it's the actual data point that came out last week. The GDP real grew by 4.9% for the third quarter, annualized. So it didn't really grow by 4.9%. It grew by 1.22%. So you multiply by that by 4 to say that it's an annualized term. But if the economy is supposed to grow at 2% annually, which means 0.5% every quarter, that's a lot of a jump from 0.5 to 1.22 each quarter, or in an annualized term from 2% to 4.9%, which tells you that the economy is really strong for the past 3 months. And I wanted to share with you the breakdown of where those 4.9% came from. And we know that the economy, 70% of it comes from consumers, 18% comes from the government, and the remaining...
Love spending our money. Yep.
Yes. You've got 18% coming from investment and the remaining coming from government and net exports. And out of those 4.9%, 2.7% came from consumers, and they were evenly split between goods and services, and within goods, durable goods and non-durable goods. So we're spending across the board, guys.
That's just called diversification there, Rabih.
Diversification. We're spending across the board, and I don't know how long that is sustainable, but that's really good news because inflation is plateauing, right? It's still staying at 3.5%. The economy is, although it's 1 quarter, right? It's posted a really good quarter numbers, and the market is coming in line to like not being overvalued or undervalued, but fairly valued, which seems that we're adjusting this to this new equilibrium. And with that, I will leave it here.
So I fully admit that I am not someone who tracks the market every day. I don't look every day. I probably look a few times a week just to kind of get a general idea. But I am curious, Rabih, with the data that was released with what you just broke down, what has been the market reaction? I think you alluded to it earlier, like not much.
No, not much, because a couple of months ago, the GDP Now tracker was saying the growth for Q3 is going to be 5% annualized. So for the past couple of months, this is what our expectation was. So had last week's data come in at 7%, everything would show up green because we beat our expectations of what the model said. And had, last week's GDP number come in like 2% instead of the 4.9, you would have seen a sell-off in equity markets in a sense, or a drop in, a change in bond valuations. So It's just because we matched expectations, although there's a lot of news, we're not moving anywhere.
Yeah. There's a lesson there that I think we're going to circle back on with what Jake's going to hit of just expectations versus reality. But Jake, you were going to say something there. Go ahead.
Yeah, just really quick, and what Rabih said has been great. But I just think it's funny how stocks in the stock market, how a lot of what is priced at is just based on our own expectations and not actual reality, I think is interesting. But it's also a way to read, people talk about, whenever bad news hits or we hit into a recession or tough times or a correction in the market, the stock market tends to recover faster than kind of the news like tells us it is, because the stock market just inherently is forward looking. If I want to take like a piece out there, it's forward looking. And so usually it will bottom out when sentiment is worse, and then it'll start growing faster than we think. And that's kind of one of the risks of trying to time the market of when to get in and when to get out, is it tends to correct itself far more quickly than our own sentiment does, if that makes sense.
Totally. Well,
So
and also to that point, Jake, it also corrects itself faster than what's happening or what feels like is happening in the real economy. Because that's the disjointment of what's happening in the market. To your point, it's just a big guessing machine of what's happening in the future. Rabih, that sparked
something so interesting. We were just looking at Q3, right? And said Q3 real economic growth is up 4.9%. But if you just take the S&P 500, we just closed October today, and this is the third month of a negative return on the S&P 500. So for the last quarters, the S&P 500 has been losing money each month for the last quarter, whereas the economy posted, over very high, real GDP growth, which shows you that they are in a mismatch. And as Jake pointed out, usually the stock market is forward looking. The data about the economy we get are backward looking.
Yeah, it's like one quick example is we all remember COVID. I think that's still fresh in our brains.
What?
Like the stock market bottomed like months before we ever had any real resolution on vaccines or different things, right, with COVID. And that kind of rebounded a lot quicker than kind of the general economy did. And so that was one thing where people missed out on that boom, because it kind of bottomed and started going up before the kind of COVID disaster was even over.
Man, the COVID thing will go down in history books, not even just from everything happened with COVID. We're not going to get into that, but just the market itself, how quickly it fell and how quickly it rebounded is just
crazy.
It's unbelievable. I think we're going to look back in a few years and be like, oh yeah, like this market anomaly on both ends of the spectrum, kind of wild. Okay, Rabih, thank you for that. It's awesome. I wanted to hit a real estate update, and then Jake will finish with yours. I think again, they'll be kind of like rounding this out with this lesson around expectations and reality. I think it'll be a perfect theme we did not plan on. So just really quick on, they just released, I think recently, I'm trying to think of when this was, a few days ago, they released, the title of it is Home Sales Slide to Lowest Pace Since 2010 as High Rates Squeeze Market. So just talking about like home sale, like these are actually home sale, or home sales happening in the country. So lowest in 13 years. I'll kind of give you just some highlights here. So decreased 2% in September. September sales fell 15.4% from the year earlier. So a total of 15% drop, decreased 2% just in the month of September, which this is not shocking, right? I don't like, it doesn't, again, we hit this update, I think a month or so ago or 2 months ago. It's not a shock as to why. High interest rates, people aren't moving. There's no inventory coming online. Builders have kind of slowed down because of what happened in 08, 09. We kind of talked about this, right? Of just the interesting, we're still feeling a little bit of 08, 09 in the sense of builders got stuck holding the bag in 08, 09. So they've like almost overcorrected with some of this stuff happening in the market. I've got two people very close to me that are home builders, and I talk to them all the time, and they're like, yeah, we don't want what happened. And like, it's almost gone the other way. So now what's happening, because home prices are down, the national median existing home price rose 2.8% in September. So home prices just keep going up. According to the National Association of Realtors, the median home price in America is now $394,000.
Holy moly.
Yeah, which is kind of amazing. And if you look at certain regions, obviously I'm interested in like what's happening in this region. I don't have it in front of me, but I know we looked at this pretty recently in Salt Lake County. it's like 500, it's almost $600,000 for median home price in Salt Lake, which is just amazing. So just a quick update there. Any thoughts you guys have on any of this?
Houses are expensive, right? That's just the thing is
Houses
interest
are
rates.
expensive.
Typically in a normal market, when interest rates go up, home prices will come down just because the cost of getting into a home is increasing. But that is not happening, as I mentioned, because there are a lot of people who have 3% mortgages or their homes are paid off who do not want to move or change houses right now with really high interest rates. And so just the demand, like there's not a lot of supply, not a lot of homes for sale. And so interest rates keep going up and home prices are remaining really resilient and keep going up. And so it's just overall really expensive to buy a house right now.
Yeah, that is such an interesting dynamic there to that point, Jake, of like the relationship between rates going up, but inventory being so low right now, again, for various reasons, just has made it an interesting market. One thing I will say on this, we've talked about before, is I still hear this sometimes of like, oh, this is 0809, like all over again, because people I think immediately equate rising home prices to what happened in 0809. That's one factor that was similar. But that was about it that was similar, right? Like
I also think some of that, Matt, is coming from, I think people are hoping for a market crash. A lot of like people who want to buy homes are like, I'm projecting, hey, this happened about 10 years ago. Our house is going to drop for 10 to 20% so I can afford a home. I think a lot of it is hope as well.
Yeah, I think that's a good point, because that was exactly what I was going to say. The second part of this is people saying, I'm just going to wait. Yeah. Like, I'm just going to wait for home prices to come down. I'm sorry to tell you, and you can mark this, you can save this if you want. This is going live on the air, as they say. So I'm putting this out there. Home prices are not coming back down, people. They're just not. They're not coming back down. Now, am I saying across the board, every region? No. But generally, first of all, historically, home prices don't come down. They just generally don't. They tend to set new floors. That's kind of the nature of the asset class. Again, you're maybe yelling out there, what about 0809? Of course, there's always anomalies. But generally speaking, across the board, real estate goes up about 3 to 4% every year. It tracks about inflation, and it doesn't generally come down. You don't often, if ever, again, 0809 being the exception, you don't often see a situation where, like for example, the stock market, you can basically book it 10% correction every year. 20%,
it happens all the time.
20% reduction, or reduction in price about every 3 to 4 years. Like, it's pretty much book it. You don't see that with real estate. And then if you combine that with what's happening just structurally with the supply and demand, and with everything that we're talking about with inventories, and not only that, the fact that 0809 used to be stated income, meaning to get a loan, we are on the other end of the spectrum now. The quality of buyers getting homes has never been higher. So this isn't just banks willy-nilly handing out loans. Like, it's actually quite the opposite. If you've ever tried to get a loan lately, it's really difficult. It
always comes down to, we just don't have enough homes being built. And then millennials, kind of my generation, is in their peak home buying years. People wanting to sell down, and millennials are currently the largest demographic of people. And so it's just a lot of people reaching that point in life where they want to buy a home, and just not enough homes being for sale. That's what's keeping prices up.
Exactly. Yeah. Rabih, you look like you've got thoughts here.
No, I'm just thinking, because in 0809, it was a demand problem. There was so much demand, and, banks got greedy, and they just created, syndicate products just to spur up more houses and to favor that demand. Right now, there is demand, but it is supply that's not there, and that's why prices are high. And if we've learned anything from the past 2 years, where we had a supply problem due to COVID, the Federal Reserve's answer to curb inflation, or to bring prices down in a sense, was to slow down demand by increasing interest rates. So the only the only time you can the only way you can slow down house prices right now, because you can't just create supply out of nothing, it takes time, is to slow down the demand. So the time when house prices may become attractive is when the consumers don't want to buy them anymore, simply because their purchasing power has taken a hit.
Yeah.
So that's the dynamic.
Yeah. Love it. The last thing I'll say on real estate, this is a big piece, I think, of breaking news, we'll say, although I think it's interesting. The whole term breaking news has kind of lost its luster. I think if you guys have noticed, like, if you ever had have any news apps on your phone that pop up, feel like everything's breaking news nowadays. It's like breaking news, squirrel water skis. It's like just everything is breaking news nowadays. But this truly is. So I don't know if we were talking about it before we went on. There was two major class action suits against the National Association of Realtors, all around commissions. They just announced after deliberation, this one did go to court, and the jury found, I'll read it to you, found because the whole gripe, the whole lawsuit was around realtors conspiring to keep commissions high. So a lot of you, I think, know out there kind of like how commissions are paid. They're only paid really on one side. So the seller of their home is paying the commissions for both the buyer and themselves as the seller of the home, which is, if you really think about it, is kind of inherently a conflict of interest. It's kind of interesting how that all functions, that only one side of that transaction is paying. Well, both sides want that to be the highest price possible, which really hurts the buyer side. Anyway, so they had this big class action suit, and this jury did find, after only a couple hours of deliberation, that realtors conspired to keep commissions high. They have been awarded, the baseline award is $1.8 billion in damages. Apparently, a judge now has the ability to triple that if he or she wants to. I don't know how that all works. So they're still going back and forth on this deliberation, but they said under antitrust rules, the presiding judge could triple the damages verdict, which could total more than $5 billion in damages. So like everything with this, there's going to be a bunch of back and forth. In fact, the NAR spokesman, they said this matter is not even close to being final, as we will appeal the jury's verdict. Of course, it'll be wrapped up in appeals. However, what I think is interesting here is there's been a lot of talk now, this being kind of the straw that breaks the camel's back of changing how commissions are paid in the real estate, the real estate industry, which I think may not be a bad thing. It's maybe an antiquated system. But I didn't realize how powerful of a lobbyist. Apparently the NAR is the biggest lobbyist in Washington as far as how much money they actually are giving to senators and whatnot. So more to come on this, but I think it's interesting that they did award it. It happened. So who knows what happens here? But any thoughts on this? Rabih's got something here.
I'm still trying to wrap up my brain about what's happening. Like now,
so
forward, they're not going to be paying as high commissions.
Yeah, people are just like, they just don't.
I think it could be one of a couple of things. I think, and I'm speculating here, but I think possibly a very obvious change would be the commissions are paid individually, like meaning the buyer, you hire someone to help you, you pay them directly. I'm the seller of my home, I pay my broker or my agent, and I don't have to pay both, because that's how it works right now, right? Is I if I'm selling my home, I have to pay 3% is the standard to each. I'm paying a 6% commission. It's all part of the transaction. So, but I guess I could technically control that. And this happens, you'll see this from time to time, where a seller will say, I'm only going to pay 2%, or I'm only going to pay 1% to a buyer's agent. The problem with that is if I'm a buyer's agent, I'm helping someone buy a house, and I see this might be a better fit. House A might be a better fit than house B, but house A is telling me they're only going to pay me a 1% and 1.5% commission versus house B is a 2% or sorry, a 3% commission. Well, which house am I going to take my buyer to? Right. I'm incentivized as the buyer's agent to have that home sell at a much higher price because it's based on a percentage. I'm also incentivized to obviously go find the house that's paying the highest commission. So I think, again, one change out of this could be that they stop having the seller pay that commission. And then secondarily, I think commissions could come way down possibly, or they just go to flat fee or something like that. So
I don't really have a take on this. I don't think my one thought would be, I want to file a class action lawsuit against like stroller companies and car seat companies. I am telling you, that is a conspiracy to keep the prices high.
Ever.
And you know what they're preying on? Me as a parent just wanting to keep my kids safe. They know I'm going to pay whatever it costs. I'll pay $1,000 for a stupid stroller or something. I want to file a class action lawsuit to get baby items and child items cost down. That's my thought.
I'm with you, man. I will lead the charge with you. Not only that, I will file a class action lawsuit against my wife and other wives out there who have to have multiple strollers, the side by side, the front and back, the jogger, the
Yeah.
I'm with
dealing with the upgrading car seats right now. I'm like, oh, we have to get new
Oh,
car seats all the time. I
don't
did
get
not
me
know that was the
started.
thing. We are just
I
upgrading
just
car
had this
seats. Okay.
conversation. Now we're going to boosters. Now we're going to boosters. Like, oh, we have 8 car seats. We have 2 kids. We have 8 car seats right now.
We need to
So-
contact those same lawyers, and what they did to kind of real estate agents, we need to do to the car seats and stroller
I'm
industry.
with
We need to get together.
you're
Okay.
triggering me now. Don't get me heated. Okay, enough with real estate. Let's wrap up, Jake, with what you had an article about
Okay.
people being wealthy and still not happy.
We can do this quickly because it's really just data that I wanted to share. Every year, I'm going to share my screen. So for those who are watching on, let's do this. Let's unshare.
Yeah,
Let's
so
get
those who are on live or going to watch us on Facebook, we'll share the screen and then we'll just move slow and kind of explain what we're looking at for the listeners on the podcast.
So every year, the Federal Reserve, they do a study on like American wealth where they'll track what net worth is and what incomes are. And every year, Nick Majuli, he has a blog called of Dollars and Data. You should check it out if you don't already. He kind of puts this data together in easily digestible charts, which I think are helpful. I know we always talk about, the common saying is comparison is the thief of joy. We shouldn't compare ourselves to others, but we just can't help it as humans sometimes. We just want to. We want to know how we're doing compared to our peers. So I think this data is interesting just to look at what are average and median incomes, what are average and median net worth. So I thought we'd start with income data, just like what is median income. For those like a brief statistics class, I think median is a better measure of this stuff than average, right? Because averages really are brought up by some really wealthy people in America. So median is like the middle person, right? So this is like there are like 50% of people below them, 50% of people above them. Median is the middle person. Anyway, so this chart, if you're watching us again here on live, it shows like the different incomes, the top 10%, top 5%, top 1% of incomes in America, split out by different age ranges. I don't know what you guys want to focus on or things here, what we want to say for the people just listening in podcast form.
I'm curious, Jake.
Yeah.
So this is showing, as you said, this is income, you said?
This is income. Mm-hmm.
So we're saying top 10, top 5, top 1. Does he break down? Does he give a median? Is there a median number before this?
I think with income, he does not actually on
Got
this. And we'll get into median because of net worth. This is just, I don't even think he has an average. This is just looking at, okay, the people are the top earners, right? If we want to classify like the top 10% in America, here's what their incomes are broken down by age range. I mean, if we want to look at from 40 to 44, the top 10% is making about $270,000 a year, right?
Yeah.
If we want to look at this data, it actually peaks of like, when does income tend to peak? What age range? It's about 55 to 59.
Which
right?
isn't shocking. Yeah, makes sense.
Yeah, that's kind of like peak earnings, about 350. 20 to 24-year-olds are about 64,000 is the top 10%.
Is the top 10. Yeah, I'm thinking about this in dentist terms, right? And just the data that we have of our clients. I'm looking at our average client is about 40, right? 39 to 40. And it's interesting. I'm looking at them. They're easily top 5% of income, which isn't shocking, right? As far as like a dentist, but I'm looking at that 40 to 44 age range. Top 5% at 446,000. It's interesting. That is about the data we pulled from our clients as far as average income by the way, this is practice owning dentist was about $450,000, which again, I'm not shocked by that. It actually makes a lot of sense.
So you can say our average client they typically make their top 5% income earner across America. Right.
Yep.
For kind of where they're at is pretty typical for most dentists.
Which is one of the reasons we point out, one of the main reasons we say dentists are different. Just from that alone, you're so different in the fact that the average practice owning dentist is in the top 5% of earners. That alone makes you extremely different from 95% of the population.
One quick aside with that now before we move on to net worth. Nick Majuli, he also runs the data of, you can break it down by like a high school degree, like high school diploma, no college. There's still like this trend out there that you don't need higher education. It just saddles you with student loans and it's a problem. income across all cohorts and age groups is much higher if you have a college degree than not. It like kind of still trumps everything there. So I guess that would be a plug for higher education, which I guess the thing there. It still works out. Okay, let's do net worth, which I think is interesting. Just a quick reminder of what net worth is. This is all of your assets that you have together minus all of your debts gives you what your net worth is. So essentially, this is your, if you want to cash out of everything, move to Hawaii, how much, money
Ooh,
could you take with you?
Now we're talking.
Now
Sell
we're
all
talking.
your car seats and all your
car
strollers.
seats in there so you can replace them. This includes your house is a big one. Most people's largest asset is their home. So this includes any equity that you have in your home. Anyway, this is the same chart as, income wise. This does show average and median net worth. You can see by different age ranges. We talked about that 40 to 44. The median net worth is $134,000 from 40 to 44. Net worth actually tends to peak later from about 70 to 74 is when it peaks before it starts going down. We talked about the retirement crisis, I guess, in America. These net worth like data could go towards that. If you look at retirement age, let's say 65 to 69, the median net worth is about 394,000, which is not that much if you think about. I need to sustain
Really
yourself living for a long time is not a huge amount. So I don't know. Do you guys have any other thoughts with this kind of median net worth data?
Rabih, go ahead if you have any thoughts on this.
No, I like it just to compare apples to apples would have been much. I'll try to find the data for next time. Instead of looking at the median net worth, which is like 50% of the population on both sides, actually look at the net worth for the top 10%, top 5%, top 1%. Or do we
might
have
this in here? Here we go. Ready?
Oh, I love it. Okay.
Here's 95. Here's or does he have 95? We just show 90. Let's do this. Here's the 90th percentile. So this is the top 10%, right? If we want to look at. So top 10% gets pretty larger. So we were talking about, it was like 390,000 was the median for 65 to 70. If you look at the top 10%, it's about almost 3 million.
Yeah.
Is the top 10%. So these numbers get a lot larger when you're going to those top 10% rather than kind of the median across America.
So I think couple of things here, and I think we could spend more time on this as well. Next time on another show. There's so much good stuff here, but I think again, just taking more of a global view and from a dentist perspective, to your point, Jake, you don't always want to compare yourself. However, I think situations like this, it's always kind of good to get some perspective, especially when we talk about we work with dentists, and you look at this across the board. And again, I think most dentists would look at this and be like, okay, I'm doing all right. I'm doing all right. Or at least I would hope so. Like, meaning, like, to your point, it's paying off. It's paid off, right? I know it can be really stressful. I know dentistry is a very lonely profession. And sometimes because you're comparing yourself to other dentists, sometimes I think it's easy to get bogged down or really discouraged, but I think it's good to see this. The other piece, I think what you're jumping to right now is I think what we want to wrap up on.
Yep. So talking about kind of what those numbers are, sometimes it's useful to see, okay, how is your net worth growing, right? So this is the same data where it shows, okay, let's look at how net worth has grown across different American households from 2019 until 2022. All right. So this 3-year period, this is the COVID kind of window we just got out of. If you look at the median net worth growth across every age group was 37%. So net worth grew by 37% in 3 years. That's not bad. I think most people would be happy, like, hey, my total net worth grew by almost 40% over the course of 3 years. I think most people would be pretty satisfied and happy with that. Another cool thing with this data that you can see, we're showing a graph here if you're watching us live, is that the age group that saw the most amount of growth, if you're listening to the news or hear your friends talking myself, the dang baby boomers is probably them. They own all the houses. They have the awesome economic environment to live and to grow up in. But actually, it's the under 35 people grew their net worth by 140% from 2019 to 2022. Like, that age group like trumped everybody else by a wide margin, which I think is interesting. So it was a good 3 years as far as like building wealth and building riches for young people, which I think is encouraging.
Just such a lesson here as far as the narrative not matching reality.
Yeah.
Right. I think if you listen to the narrative, and when I say the narrative, meaning like what you hear on media or social media about this, like crisis of, you know, just
We just talked
things
about
not-
it. Home
things not
prices are
being as
going
good.
up.
Yeah, exactly.
Interest rates
Things
are high.
not being
Inflation
as
has been
good.
high. A recession is on the horizon. There's all these
Negative things.
negative things where it's like, oh my gosh, things must be really bad out there. But if we kind
Yeah.
of just look at this objective wealth data, people are getting wealthier despite all this scary economic news. And I do think we go back to this time and time again. Media, financial media outlets, CNBC, different places like that, they want you to keep engaging with their content, right? Nobody
course.
checks the weather when it's 70 degrees and sunny outside, right? We don't care. But
Yep.
everyone checks if, like, is there a storm coming up? What's happening? Is that's the same with news. They are trying to, their incentive is to get you to try and click on their content. And the best way to do that with finance stuff is to scare people, usually.
So true. It's so true.
We're doing the opposite, I guess. So maybe no one will listen to this, but we're
No
telling
one
you
listens
that
to us for a reason, and it's not because
Yeah.
we're bad at what we do. We're actually really, really good at what we do. We're just too optimistic. That's the problem.
we're too optimistic. Yeah. Anyway, that's all I had here.
No, that's really good. I think the main point here, like we were talking about earlier with expectations versus reality, I think just this whole idea, because that article that you just referenced, Ben Carlson has another article that references, right, of like, we've never been wealthier and still no one is happy. And I think, again, I think a lot of this just comes down to like expectations are outpacing the wealth increases. Although the wealth increases in real terms have been amazing, I just think its expectations have grown faster, which always leads to a problem there. So
one quick point there, Matt, I think
Yes.
is important. Someone will come at us, be like, well, inflation's been really high. Those numbers are adjusted for inflation, if you're wondering. So
Boom.
that's like inflation adjusted
They're like,
numbers. in
don't
case
come at
people
me
are
with
like,
inflation, people.
Anyway,
Yeah.
anyway. Okay.
We
last
do
thing.
get some angry emails sometimes, like when I define how, like what was it? What was the
Chicken-
food item?
Was it chicken fried
chicken,
steak?
Chicken fried steak. Chicken fried steak. I was very rightfully called out. So, all right, guys, this was amazing. We went a little long. We apologize. Hopefully, it was good stuff for you. That was our 2 cents. Until next time, bye bye.